Yes. Hello. So we start. So we are Pakistan's first life and health insurtech. We established in August 2016 when we acquired a company called Asia Care, which was into a retail health business. And then we commenced our Takaful operations in 2019. So what exactly do we bring to the table? So again, being the first life insurtech, we've had digital payment enabled insurance app which was integrated with life and health tech ecosystems and UBI platforms. Innovative, bespoke, usage-based product offering targeted towards masses with payment via mobile talk time. We were the first ones to get into that. We have in-house tech capabilities which support, of course, distribution claims, entire back office, as well as the health tech platform that we have, as well as the individual life business that we write. And I'll be talking about that later in the presentation. We're the only ones at this point in time who've got instant scratch card insurance products, which are being actually distributed into tier 2 and tier 3 cities, which are mostly the rural areas. And this is being done through microfinance institutions and telcos. So who are our key partnerships at this point in time? So we are, alhamdulillah, proud to say that we partnered with Mobilink Bank. We've got the Islamic Bank. One second. We've got the Islamic Bank, we've got GS Bank, we've got Bank Al Falah, we're working with Jazz on certain few initiatives, we've got Faisal Bank, we've got UBL on board, and we've got Payback. On the reinsurance side, which is definitely a key question for a life insurer, we have Alhamdulillah Munich Re, which is kind of a double A rated, triple A rated reinsurer, and we've got Gen Re, which again holds the same accords. The key features that we have is we've got a credit rating of A from PACRA. We've got a double A reinsurer rating for in terms of IFS PACRA. We've got close to 20 plus retail products, which we'll be talking about. And we've got about 300 plus panel hospitals nationwide, mostly in tier 2 and tier 3 cities, depending upon the target audience that we serve and the target market that we cater to. So what are our future growth avenues with regards to our both health and life products? We've got telcos, we've got bank assurance, which is the traditional banker that we have in the industry. We've got an agency-based model, and we've got app and web platforms to enable our customers to buy our product. So what is our growth story from 2017 to 2025? So we started off with retail scratch cards. This is again the first in the industry and still the first in the industry at this point in time, whereby just like you buy talk time for easy load for say for Jazz or for Ufone, the same way we've got scratch cards of various products which the customer can buy. They go as low as 800 rupees and they go as high as about 7,500 rupees annually. The customer can buy these scratch cards from the bank and they can scratch it. There's a short code where they have to send it. So that's how we register the client's mobile number, his NIC, and the plan that he has bought. So this was started in 2017, and the scale was actually achieved much later, which I'll be talking about later in the presentation. In 2019, we had WhatsApp integration. So WhatsApp for Business was live before COVID. You could buy our products. You could get policy administration and other facilities for the customers were offered on our WhatsApp. Then end-to-end digital telehealth, this was something that we partnered with during the COVID times. We partnered with various outside entities, including Ola Doc, Mentor Health, Find My Doctor, whereby a customer can easily talk to a physician using a smartphone and can order online medicine, plus get tests done at the convenience of their own home, rather than going out in the market or going to the hospitals. Then in 2021, we moved towards a usage-based platform. So instead of yearly policy, we started daily, weekly, monthly, and quarterly and half-yearly plans. Again, we were the first ones to jump into this target audience. And this was enabling the mobile app purchase and then the payment via mobile talk time. So the scratch cards and this is basically a digital version of the scratch cards that we had launched earlier. Then in 2022, we introduced products for our call center. Our call center is very much live. It sells, other than the regular health and life product, it covers parental and dental cover, which a lot of companies or IPs are still not into. So we cover parents if they start with us from the age of 50 till the age of 90 years. If you get on the bandwagon with us on the age of 50, then we will carry you till the age of 90 years. And the pre-existings are also included after 5 years of being with us as a customer. So we've got a very healthy persistency ratio over here. Persistency basically means the amount of customers that renew with us on an annual basis and the ones that we doubt. In 2024, we started our unit-linked takaful, which was a big bang, which we started with the Islamic Bank in December 2023. So January 2024 was the launch date. And in just 2 years, this segment or this vertical has, for this year, like we've targeted about 250 to 300 million rupees coming in from just this unit-linked takaful business. In 2025, we went into a rural expansion, which was refueled by a partnership with Mobilink Bank. So although Mobilink Bank came on board with us in 2019, but we weren't able to scale it to the level that where this could be a very sizable vertical for us. So Alhamdulillah, in 2025, we started this expansion. We went and visited their branches in tier 2 and tier 3 cities. We held conventions for the branch managers in terms of training and in terms of then visiting their branches. And then, of course, looking at the footfall at the branches, we were talking to the customers and we were spreading awareness for both health and life products. And this again is right now, I think, one of the biggest verticals that we have, probably after the unit-linked takaful that we have. So in terms of executive summary, what was the year-end CY 2025 like? So it was 77% achieved, company achieved as compared to the budget. We did 506 million as compared to 659 million, which we had budgeted. In terms of corporate budget, the achievement was 163% higher than what we had targeted. But we'll be telling you a story whereby we've shied away from the corporate business from 2022. At that point, we had about in 2021 close to 90% of our business was coming from corporates and 10% from retail. And then we pivoted from that end to a very healthy retail base of 88% in CY 25 and only 12% of corporate. So 72% of retail budget was achieved, which was 447 million achievement as compared to the budget of 623 million. 97% was FIG and agency contribution. FIG and agency is basically the feet on street model, which we have, again, the one which I was explaining in tier 2 and tier 3 cities. Not ignoring the tier 1 cities, but mostly these are tier 2 and tier 3 cities where we find less competition and there's the prices are sort of how should I say it, profitable enough for us to operate in that market. They have a very low claim ratio and so on and so forth. So we did about 387 versus 399 million, so very close to 100% achievement. And on the digital side, there were a few schemes that we had in 2024, which we let go of in 2025 due to an adverse claim ratio. So there was 27% achievement on the digital side. So instead of 61 million, instead of 223 million budgeted, we did about 61 million. The channel contribution to top line, the first graph which I have on the right is 86% to 14% between retail and corporate, which slightly improved from 2024 to 2025 to 88% corporate and 12%, 88% retail and 12% corporate. This is also quite visible in the number of lives that we've covered. So in 2024, we had about 2.4 million lives covered, whereas in 2025, there was a jump of 46%, and we did about 3 million plus lives, which were insured by us in CY 25. So what was the strategic pivot which I was talking about? So in 2021, as you can see, corporate was 67% of the business and retail was only 33%. And even out of this retail, most of these were embedded schemes with the bank, so that we would consider them under the group life or the credit life scheme, so that again contributes to corporate. So total business was about 640 million. In 2022, there was the first step where we let go of close to about 300 million rupees worth of corporate business. And there was a slight impact on the retail side. In 2023, the corporate business was at 38% with 164 million contribution, whereas the retail started jumping back to a higher gun, which was 271 million achievement that we did. So total business was 436 million with 62% retail and corporate 38% in 2023. In 2024, as you can see the graph steadily going up, 14% was only corporate and 86% retail, and we let go of, or we sort of took a chunk out, about 110 million rupees worth of business from corporate, and we did about 335 million rupees worth of retail business. So what we undid on the corporate side, we sort of regained on the retail side. So this was basically the pivot that I'll be explaining later on as well, from a very B2B business to business to a very retail-led growth business that we, along with, have today. So in CY 2025, we did about only 58 million rupees worth of corporate. And these are the corporates that we've retained from 2024. They are profitable in nature. I believe close to about 80% loss ratio. So they do give us that 20% margin for us to play around with. Whereas the retail was again jumped by another 100 million. So we did about 505 million rupees worth of business with 88% contribution coming in from retail ventures and 12% coming in from the corporate. On the graph side, you can see the corporate and retail number. The retail growing by leaps and bounds, and the policy numbers also going up in terms, because retail has a lower ticket, whereas the number of policyholders goes up exponentially. So redefining our business mix, what was the execution strategy over here by building the retail engine? So first of all, the MFIs, microfinance institutions. So we pioneered an untapped, low competition segment using a blue ocean strategy, which means a large addressable market. As we all know, if a conventional bank these days has 10 million customers, a microfinance bank has about 40 million customers. So we went for the larger addressable market with minimum comparative friction, because if you look at our competition, RMG, Jubilee, State Life, or EFU for that matter, for them, a 300 million contribution coming in from MFI as compared with their 40 billion rupees worth of business does not even come to close to about 1% of their business. However, for us, where we are targeting 800 million this year, a contribution of 300 million is close to about 40% of our entire top line. So this is why we actually moved to this market. On the ULIP Bank Insurance side, we went ahead with the Takaful side first, and we launched with Dubai Islamic Bank, and we scaled it. So instead of going with 10 banks and spreading ourselves thin, we worked on the blue ocean strategy, whereby we would work with one or two partners. In this case, Dubai Islamic Bank was the one leading the front. And just like I mentioned, in CY 26, we're expecting about 250 to 300 million from them in terms of unit link for business. And that was done through Dubai Islamic Bank only. On the international health coverage, this is also one of the first that is out there in the market, and I still believe we're the only ones who are offering it successfully. So this is the product for the richest of the rich. So this segment is basically a $500,000 cover minimum that you can have for any kind of emergency that you may have when you're traveling abroad. So this is aimed towards the C level that we have in the market. So most of our customers are either CEOs, CFOs, or chief operating officers, or entrepreneurs, or owners of the business. And we've grown this segment from a mere 20 million 3 years ago to about 110 million vertical for this year, CY 26. And CY 25 comes out, it was again 100 million odd contribution. On the digital call center side, of course, calling a digital call center simply means that the call center not only receives the calls or makes the call, but the journey of the customer also ends in a digital fashion. So the customer gets an OTP which they can use to pay using any easy wallet, bank wallets which are out there, or a bank account, and they can do so online. And that's how we're reaching mass retail customers. Although we're doing about 50 million to 60 million rupees worth of business at this point in time in digital call center. But with initially we had about 50 call center agents, and now we're only at 4, so we're doing efficiently very well. So we've cut down our cost on the digital call center, and we've realigned that cost in terms of MFIs and ULIP business, which basically means feet on street rather than call center agents which are there at the call center. Then the banking partnerships, we've always had, and we've invested with certain bespoke solutions that we've devised with banks. So embedded life and health insurance solutions work directly into bank account holder journeys. This includes women-centric products. This includes certain age-centric products. This includes millennials and Gen Zs being targeted as well. So this does enhance banking. What this basically does is give the bank a better proposition as compared to another bank, and that's what we provide to our banking partnerships. And this drives our retail volume. So, for example, I can give you an example of UBL Tez Avatar, which is the biggest remittance scheme in the country at this point in time. And we are, alhamdulillah, the only partners or the exclusive partners of that relationship. So whatever remittance the remitter is sending back to Pakistan, say about $1,000 a month, if God forbid something happens to that remitter in any part of the world, then that same $1,000 worth of remittance will be given from our side to the recipients for 6 months. So that's how we've picked up this partnership, and it's been going strong and steady for the last 2 years. And in terms of claims ratio, this is also extremely profitable, probably with us 5% to 6% claim ratio. Corporate discipline, scale down to our basically entire group life and group health accounts that we had. Group health we let go of back in 2021, and group life accounts were almost reduced to a 55 million top line in 2024. So there is no corporate, or I would rather say there are less corporate customers that we are serving at this point in time. So quality over quantity is basically what we've ventured into. So some might say that we've actually gone into quantity because of the number of policyholders are now more. But what it basically means is quality in terms of what the customer brings to the table, which means low claims ratio, low admin cost, commission ratio is slightly higher on the bank insurance side. But other than that, these are healthy businesses which render at least 25 to 30% bottom line as compared to corporate, where only the claims ratio is 80 to 85%. You add on top of that, there's a 10% of commission, and you're left with hardly 5 to 10% margin to play around with. So moving on, what does our external partnership landscape look like? So just like I mentioned, embedded schemes with partners. These are basically Credit Life and Credit Shield, health insurance and telehealth products that we have both on the conventional as well as the Kafil coverage schemes. And they are basically offered in collaboration with banks, asset management companies like Mizan Asset Management, and fintech partners to enhance their product value proposition to their customers. So the customer does not onboard with us directly. The customer basically becomes a customer for the bank, and automatically with all the other goodies that they get from the bank, what they get is a free life cover or a free health insurance up to a certain mark, or OPD, or a telehealth solution that we provide on our own platform, which is integrated with the bank as well. So the banking customer can digitally access any physician as well as get their lab test done, plus, of course, get their medicines ordered online and delivered at their home. Second external partnership would be the branch banking, which is bank insurance. Again, this is the conventional bank insurance that we talk about. Conventional not in terms of the product, but in terms of the insurance model, which is hub and spoke model that we're working at this point in time with. So currently we have the Islamic Bank, and we're trying to onboard other banks as well. And since now we've got 2 years of experience in the bag, whereby we are close to about 300 million to be hit this year in this vertical. So that experience and that confidence has given us sort of a success story to go and preach and then get unit link from other banking partners as well. We are also launching this with our microfinance bank. So this unit link product could be as low as 5,000 rupees. I believe the next in line as compared to this product was a 25,000 rupee cover for an annual 25,000 rupee cover, which we have brought down to only 5,000. 5,000 something which anybody can afford. And it does give you about, I think, about 100,000 rupees worth of life insurance. So it's a multiple of 20 that you get, plus you get this money invested, and of course, investment goes at a certain net asset value, which is again published on our website. Last is the digital angle, which is the call center and app-based plus aggregators that we work with, like Smart Choice and Cardo.com. So again, here we've got insurance, Cardo Compare. So we've got insurance and the government products, which are again being offered through our banking apps and call center distribution channels, not only of our call center, but call center of banks like Dubai Islamic, Faisal Bank, that we're working with, Bank Alphala on the app side. So these are the three basically external partnership landscapes that sort of we're working on. In terms of internal partnership landscape, we've got corporate and group life division, which I explained briefly, and I touched upon that about 50 million uh, is 55 million rupees is what we're looking at from this vertical. Nothing spectacular, so we will just keep it steady and healthy so that it doesn't cut into our profits. Then we've got the internal call center app and website. So this is the internal call center that we have, and I spoke about this. We have about 5 call center agents at this point in time, which are working, from 9 to 6, and 4 6 the customer can leave their number and we can get back to them the next morning. Other than that, we've got the app and website, which of course also is a digital platform. So in terms of Facebook, Instagram, Snapchat, we're pretty much present everywhere, and we do about 1 or 2 posts a week, and that is what basically churns or it provides the engine for this digital platform to sort of gain benefit from or get the customers onboarded. Last but not the least, and the biggest of top line is the DSF, which is direct sales force, which is feet on street. We've got field-based sales agents deployed all across cities and localities to engage customers directly, driving insurance penetration through in-person advisory, relationship-based selling, and on-ground policy enrollment. So this is where the scratch cards come into play. This is where unit-link products come into play. And I think together they constitute about 500 to 600 million rupees worth of top line at this point in time in terms of CY26. So in terms of performance review, before we move on to the financial aspects of it, and I pass on the baton to Kalam Saab, just to give you an idea of what CY25 actual versus budget looks like. So digital was 41% achieved at 42 million versus 104. FIG and agency was 104% to 66. Just 1 second. Sorry. So on the life side, we did corporate 163%. Digital was 15%. Just like I mentioned, there were certain embedded fees let go of. On the FIG and agency side, we did about 83% of our coverage. So a total 77% achievement of corporate, 163% to 27% digital, and FIG and agency 97%. So life was 39%, health was 61%, 88% was retail, corporate was 12%. And just like I mentioned, budget versus achievement, corporate of 163%, retail of 72%, and the company overall achievement of 77%. If there are, okay, so this is. So this is CY25 versus 24. Again, 1.29x on corporate, life was 1.0x, health was 1.49, corporate was 104, retail was 1.33, and the division of retail was digital was 0.57x as compared to last year, and the 5G and agency was 1.69x. In terms of innovations and what digitization we are now currently following at this point in time, so we're looking forward to a sales CRM from leads to deals, sales flow, sales funnel. This again is being done in-house at this point in time, completion time of 1 month. In terms of AI automation, we are collaborating with Boston AI, which is one of the, I would say, most advanced AI out there in terms of health coverage. So what Boston AI does is basically it gives you an AI agent which basically asks you all the questions which are there in our application form. So instead of the customer filling out our application form, they can simply talk to our Boston AI agent, which is called Harmy, and then they can answer those questions, and those questions will then be populated or transcribed into sort of a written statement for our underwriters, and it will go straight to our insurer. if it needs to be sent. So we're looking at about 2 to 3 months on this end. On the sales portal post payment, this is again a process flow mapping between health underwriting and IT. In another 3 to 4 months, these will all be done in parallel. Then we've got customer docs communication, performance-wise invoicing, and a real-time dashboard for case visibility and tracking as to where the customer is. This is mostly applicable to our January customers as well as our unit-linked customers. And this is again between health and ops, and this will take about 2 to 3 months as well. Last but not the least, the standardized document checklist will be uploaded to ensure completeness. This is with regards to the regulator as well in terms of FATF and AML integrations that we're planning to do. And other than that, the real-time visibility of claim statuses and tracking and a centralized dashboard for the customer. So this will be on the claims and the IT side at 2 months needed to complete this journey. So basically what I'm trying to humbly submit is the fact that by the end of this year, we will have sort of completed most of these sort of BRDs, and we will be going ahead with AI automation and integration with us. So TPL Life is still holding on to their digital insurtech platform, scaling it alongside our feet on street, which is, of course, at this point in time, a major contributor. Now we move on to financial review, and I would request Kalam Saab to please present the P&L.
Bismillah ar-Rahman ar-Rahim. I think Sasab has already explained the top line, the blend of top line health versus the unit-linked policies and the corporate sector. So, if you see the second line where premium ceded to the reinsurer, this predominantly entails the risk that we part with the reinsurers. So, as Sasab has also explained, that we have got two leading reinsurers, Munich Re, one of the top companies of the world. So, like all our life policies are placed with Munich Re, and whereas the health insurance, the international health, that is placed to Gendi. Gendi is again an American firm. It's a huge firm, and there we take international health cover up to $500,000. The third line is the movement in the insurance liability. These are actuarially based figures, and this is a consequence of the revenue generation month-wise. So what happens is, like, it records the movement in the insurance liabilities as the year pertains, and it moves on to look forward the unexpired risk. So if discounting all these things, the net premium revenue generated 303 million versus 263 of last year. And investment is slightly down. There were a couple of factors. The downing of the interest rates, the carbon rate, and plus we had made certain payments to the reinsurers. So that was a consequence of downing the investment income. Insurance benefits is this basically the 82 million figure entails the claims. So in terms of ratio, the claims ratio is about 27%. I think I reckon this is one of the lowest in the industry. And last year it was 23%. So there's no major surge in the claims. Acquisition expenses are higher, and the ratio is around 50%. Why is that? As Sasab explained, this is our strategy to move to the personal lines business, to the retail model, and the retail model through a bank assurance that the acquisition costs are higher. Because what happens is this acquisition cost entails expenses that are catered by the distributor. So like distributor, they have their call center. So obviously there's a charge for that. Then there's a commission for that. So the cost, I reckon, around is 50% of what the premium is generated. The administrative expenses are lower compared to last year. The reason predominantly is last year there were a couple of one-off expenses. We had gone with the reverse merger, and the cost was 95 million and plus about 25 odd million that were incurred on the legal expense as a consequence of the reverse merger. And then we had washed out the bad debts. So there was 75 million provision for bad debts, and this year these items are not obviously repeated. And financial charges are consistent with last year. So the loss after tax is about 208 million. The EPS is obviously in a loss, was minus 0.93. That's the basic strategy. Again, this is the year-wise presentation. If you see, like we were at one time, we were achieving a gross premium of 1.3 billion in 2020, and with change in the management strategy, because we were at that time, the portfolio was heavily poised with health insurance. So, like I reckon about 90% of the business was emanating from the health side. So like what we have done, and then health was again, it was not retail health, it was corporate health. So corporate health is as bad as health insurance. So like we tried to reduce that risk. The group health and the health insurance, these were contained in the subsequent years. So obviously there was a downfall in the premium, and now we are on the path that our retail model is working very well. And as you have seen, that the loss ratios are pretty low. The loss ratios are around 27% this year, and we expect it to be hovering around something around 30%, which is again a very lower rate. But obviously, then your question will be then when the claims are lower, but the expense outgo is higher, because like we need to build up the top line to cover the fixed expense nature, so that like expense absorption, that is the key point where now we are striving to get to achieve that, to in order to reduce the expenses, or the expense ratio will be obviously absorbed with the growth in the premium. And as Sasab said, we have first time like we moved to the pure life insurance product with the banks, mainly with the DIB, and that DIB model, that the unit link policies obviously is a long term. There is a break-even period of 4.5 to 5 years. That's the break-even period. So we will see the deterioration in the profit for a couple of years, not more than that. And inshallah, we expect that we'll be inshallah doing break-even point, reaching the break-even point maybe in a couple of years.
So that's it from our end. If there are any questions, please let us know.